What documentation will I need for an SBA 7A loan, and how do I supply it? Hi, this is Michael with Viral Funding Solutions. Let me jump right into things. I get this question asked a lot. What documentation will I need to supply, and how do I supply it? So I have my laptop out in front of me with the documents needed that I will use as guidance. Yes, I have it all up here, but I want to use this so I just don't miss anything. Starting from the top, and this correlates to the year we're in and the previous year. So since we're in 2022, in November, I'm making this video, we will need last year's 2021 business bank statement. So if we were in 2023, that's right, we would need 2022 business bank statements. So from January all the way to December, no exceptions. Make sure you have all of that. And as we're going along with this, just make sure that you're ready. You know, you may not have it all stored somewhere, but you need a little bit of time to put some of these things together, maybe. I always tell business owners is just have this in a folder, Google Drive, wherever you put it, wherever you store this, so it's ready to go and you're updating it over time. So when it comes to getting funding, you're ready to supply this. And not everybody has all this documentation, so there may be alternatives. And if you don't even qualify for this, there may be a different option. So I've already created content on the SBA 7A loan program, as well as done some examples with the maximum funding amount, debt service coverage ratio, net operating income, total annual debt service, and a few scenarios there to look at that I'll link you to down below. So make sure you check that out, as well as my free business funding questionnaire you can fill out to get a very personalized and customized email response on your best funding option and options. Thoroughly, I will walk you through, I will evaluate, analyze, and give you a proper response back via email on what your best funding option and options may be. So this may be the best one, but what are other options? Maybe you're looking for bridge funding in the meantime. What qualifies you for that? How does it work? What are the numbers there, perhaps? And a bit more. So make sure you fill that out. I would do that as a priority number one if you have not yet. So coming back to this, we said the 2021 business bank statements. Now, for the current year, 2022, recent 6 months of bank statements. So if we went into 2023 in the beginning and we're not 6 months into that year yet, yes, we would still need that overlap, and we would probably only need to supply just 3 months or wherever you're in at that stage. So 2022 recent 6 months of bank statements, you should have that, already done, updated, and it depends on when you're applying as well. If we're gonna need, we're crossing into December, perhaps the last day of November into December, you might need that to wait to get uploaded for November statements. And there's also all these like month-to-date bank transaction reports, but the bank statements is ideally what we would need there. So make sure you have all of that. 2020 and 2021 profit and loss and balance sheet. So let me back up really quick. So when people ask me, why do I need my bank statements? Well, we're going to look at overall revenue of your business. How are you depositing? What's your frequency of deposits? Electronic wire transfers. How are you transferring is another question, because I see all of these bank statements and they may be good. Other ones we are not able to verify how you're getting that. Is it being sent from a personal account to a business account? Can we track those vendors? Too much transfers in ways that it doesn't look like it's a go for the lender. It looks like you're manipulating bank statements, whether you are or not. That's out of the question, whether you intentionally mean to or not. It's not verifiable, and just the way you're getting paid. So I always recommend depositing into that one primary business revenue checking account, the one that you're going to use to go and apply with you get funding in all other ways, not just SBA funding and so forth. But you have the 2020 and 2021 profit and loss and balance sheet. So that also correlates to the year. So 2023, 2022, 2021, more so. And what I say is have these separate. Most business owners, they don't. They tell me, hey, just refer to my business tax returns. The profit and loss, whatever you need to see, it's in there. And I get it. I know that. I've seen it already. By the time you asked me or you told me that, I already know that. I perhaps already did my calculations, but the lenders want to see it separately. And it's easier to track. There may be something that isn't missing, or there maybe is something that's missing that we need to look at, or it just gives us more details. It's more professional. It's a better setup, easier way to look at. And so make sure that is that way. And it can be acceptable in some ways if we look at just your business tax returns. There are lenders out there who will say, well, you don't have those profit and losses created for the previous years, but you have it for the current year. Well, It's okay. We can look at your business tax returns and just determine from there. But others will say, we need you to create those. We need those done. And it may be no fault to your own because your CPA or somebody else told you, just look at your business tax returns. But when it comes to government funding, you have to have that kind of stuff together. Other types of funding as well outside of the government. And this is how it works in this world. There may be an exception, there may not be, as I just mentioned, but make sure you have everything. Now, year-to-date profit and loss and balance sheet. So the current year profit and loss and balance sheet. And I'll tell you, is it at least through quarter one, quarter 1 through 2, quarter 1 through quarter 3, quarter 1 through quarter 4, etc. And it just depends on where we are. So right now, quarter 1 through quarter 3 is more likely what I will need to see because that's what we're in, quarter 4 now. But you have quarter 1 through quarter 3, have that. Make sure it's there. A lot of people have it. That shouldn't be a problem. Make sure you're keeping track of all of this, your expenses, your income, and that'll also help me determine like debt service coverage ratio. And you have your balance sheet as well. But debt service coverage ratio is an indication of your cash flow and how much cash flow you have to service the debt and your current debt obligations and the debt obligations if we were to give you any more on top of what you have, if any, on interest and principal, etc. I'm going to dive into that in a little bit too, but down below I gave you examples on the debt service coverage ratio and then the SBA 7A by itself and a few other things like this of what I'm already going through. So previous 3 years of business and personal tax returns. And just so you know, I do pre-underwrite files before they go into the lender and / underwriters. So I can make a determination and I can communicate to you what I'm seeing. But not in all cases will I do that. I'll just say, hey, submit it over to me and we're good to go. I'll look at it myself. Boom, send it over to the lender. And I always prefer you send it to me. You can send it via email. There are ways for us to upload it online and see it in our back portal. I do more of an in-house setup. There are other ways to do it, like if you went through SBA.gov, but that's not what I prefer. And you shouldn't be doing that anyways, because the flexibility, maybe the fees are going to be a lot higher, the guarantee fees, all of these other things that you're looking at, the amount that you're getting approved for, who's actually looking at your file? Is it a preferred lender? Do they actually know my industry? Is there more flexibility involved? Can I get better years, terms, rates, etc.? You may not. You may go over here to a credit facility underneath this lender that's more old school and they only care about you having some kind of collateral. And if you don't have that, then we won't accept you. Not all SBA 7A lenders are created equally. They won't always need collateral. They may need to see what you have assets and liability wise, but they're not going to say, hey, we're going to take collateral. We need it. We just want to know what's there just in case. And they can give you funding because you don't have collateral. But there are other qualifications you should meet. So I'm going to leave that video again down below. If you want to know what the qualifications are, I won't cover that in this video. So make sure you have all of that. And it gives you a lot more flexibility. And yeah, you may be thinking, well, why can't I just go to my bank? Yeah, but like I just mentioned again, there may be more old school ways that they do it. And it may not be most up to date. You're in the construction industry where you're getting looked at from somebody who's done more deals in manufacturing. They're trying to relate. They don't understand what's happening at a macroeconomic scale, what could be appreciating, what could be depreciating, where we could be in a month to 2 months down the road. The lender isn't up to date on everything. There's a credit committee, that looks at all of this and how they meet or how they do things and operate. The paperwork, it might be more extensive and stuff that's unnecessary. The underwriting takes longer than what it should. There's more information that needed to be supplied. The way you gave up collateral, the way they put a lien on your home or your personal assets or whatever that may be, in a way that you didn't like it. You had more control and flexibility doing it this way. There are some cases where they go, hey, we can lessen the rate a little bit, but not in all cases does that happen. That's not even the major difference. And what you should be looking at is longer term and having that relationship with somebody that has actually been doing this and knows what they're doing and they can help you in and out at any point, not turning to somebody who won't help you. So this is why I prefer it this way, that you don't go through the SBA.gov site by itself that way. There are many advantages and a lot more disadvantages, I would say, doing it like that. And an in-house setup, which I prefer. There are different in-house setups that I have. And you can also get bridge funding in the meantime. I think I mentioned that in the beginning, but you can look at an unsecured term loan, cash advance, and or a line of credit to add on top of as bridge funding. You can use immediately if you need to cover anything, any kind of gaps. You have a big project. You can't wait 6 to 8 weeks or so, 4 to 8 weeks or so for the SBA loan for you to receive it, because that's what it could take, 4 to 8 weeks, more so 6 to 8 weeks plus, but especially in this economy. So just understand that, Yeah, you might need funding in less than a month, and you're like, I needed it in these next 2 weeks are going to be hard. I have a hard season. I need it. This is actually my biggest season where I'm going to go up, but I can't wait. So what happens is then you can consolidate. Whatever you get here, you can look at consolidating. So if you got 12% interest for a term loan, for 12 months at about 100,000 more or less, let's just say that for an example. Well, you only used up, 3%, 6% of that, maybe not the full 12%. And then we could consolidate that. So, and it's your choice. If you want to leave it by itself, we can leave that in conjunction. That's fine. You can always come back and get more funding here. There's consolidation, refinance ways too, and a lot more uses for the SBA 7A that I won't cover here in this video. Link down below for more. Now, year to date, again, as I said, profit and loss balance sheet depends on the quarters we're in. Previous 3 years of business and personal tax returns, obvious, right? And so make sure you supply that. Other lenders, they'll say, hey, 2 years, but more so is what you want, 3 years of business and personal tax returns. You always see those put together. So 2019, 2020, and 2021, and then correlating years, we'll factor in the 2022, 2021, 2020 years. At least 2+ years of profitability is what an SBA 7A lender looks for. Profitability in general, but 2 years of profitability is best, especially with our economy on a macroeconomic scale and the shifts. And I'll go into how that affects the debt service coverage ratio and what you get approved for. So please stick with me on that. And so we're looking at inflation, we're looking at this recession and how deeper we're going into things and how the interest rates are increasing. And if they keep increasing as I project them to, that decreases your borrowing power initially. So if the increase in interest rates comes up, then you were probably sitting at, let's say, 700,000 at 9.25% for a standard SBA 7A loan. Well, if the interest rate, let's say, were to come up, then we're looking perhaps at dropping that borrowing power initially, maybe by 100,000, more or less. That can happen. So maybe you start off with 600,000 then. And then you can always get multiple SBA 7A loans. So that depends on the time we're in, how far we've gone into it, etc. But yeah, that's another indicator, and there are more things I don't want to bore you with on a micro and macroeconomic scale. Now, over here, aging AR, AP reports, accounts receivables, accounts payable reports, if applicable. So what you're owed, what you have to owe. That's very telling. Like, we have to know what kind of debt obligations you have, who you still have yet to pay, who still has yet to pay you. When this factors into like unpaid invoices and accounts receivables, invoice factoring, right? Because that's the preferred thing that the SBA likes to see for collateral. There's real estate equipment and a few other forms, but they won't always ask for collateral, right? So I'll talk about that in my other video. So make sure you look for it down below in the description on the qualifications and just some of the requirements on what they were looking at as alternatives. If there's no collateral, it's okay. They're looking at strictly cash flow. It's high enough in cash flow. We don't need to accept the collateral and other things. And lender, it varies lender to lender. Business debt schedule, if you have any debt. I know I've come across a lot of business owners who do not have any debt. We may still need you to fill one thing out that goes not available and not applicable, whatever that may be. Or in a lot of cases, we don't even need to ask for a business debt schedule if you have none. So that's okay. You may have your own business debt schedule, and I may have my own in-house debt schedule, and that's what we want. So we'll want you to transfer it over, but not in all cases. It can be acceptable with what you have over here in your own form that you created, and we can take that. It just depends lender to lender, and I'll let you know if that's adequate. Application sent via HelloSign, and this is the part that you should take your time on. And so you'll get a lot of the times with these fintech companies and how the lenders operate nowadays with an in-house setup, there's indirect brokerages that I already have those direct partnerships with. It's better to go through this brokerage because of the flexibility, the way we can look at soft pulls versus hard pulls. Soft pulls initially before a hard pull. I review all the documentation myself. Then I have my team that I may tell you a little bit more about how that works and how we operate, how we're at every point in the process. I know what's happening underwriting your offer. I know what the lender's feedback is, and we can communicate that. And so just understand that I want you to make sure you fill out every field of that, including your signature, dating it, signature, printing it, dating it, making sure you have your social security number, your SSN. That's very important. And I know you're probably apprehensive, especially if this is your first time with me, but that's to verify who you are, your eligibility, and more so your personal credit. That's a determination of social security numbers. Your personal credit, we can look at things like that. We can pull things from it and see it with a few more things. And it's very safe and secure, especially when you come through me. So when you go through someone else, I can't say for sure. You may need me to verify, but just be very careful about who you turn to, because a lot of people overpromise and then they underdeliver. They could scam you. They could be out there just to make money. They bait and switch you. They promise you something more than what you were supposed to get than what you were getting. Who do you trust? Who's reliable? I am that person who's trustworthy and reliable. I'm an expert business loan broker, if I didn't say that in the beginning, but I've been doing this for a long time with all types of industries, not just one. I focused for a good amount of time. I focused on trucking, and I know that industry very, very well. And then I spread out over years, and then I really got into everything: construction, medical, retail, restaurants, manufacturing, aerospace, everything in that. And the benefit of coming through me too is in my early 20s, excuse me, after college, after school, I took time to work in different fields, trying to figure it out like a lot of us do. Like, hey, this isn't the proper role for me, but at least I got skills and I learned that this wasn't for me. And sometimes you got to learn those things. So I have industry experience with construction, manufacturing. I did warehousing, I did retail, I did a few other things, but it's giving me a broader scope on the way that businesses run. And I'm a systems guy first. That's how my brain works as an introvert. So I love systems. I like, how do I improve systems? Not necessarily always create them, but improve them or make it flow better from here to here. Like if you have a pipe, make sure that the water's going through it and nothing's leaking, nothing's shifted and it's coming out another way. And I like to improve things. And so that's a great thing. And so I worked on digital marketing. I did digital marketing. I had a digital marketing agency, affiliate marketing, businesses, and a few other things. And then I merged into business loan brokering, which is what I always wanted to do, by the way. So this was always on the back of my mind. Finally was able to do it. And I focus on this primarily. So I know my stuff in and out. Over here, as I mentioned, application, usually sent via HelloSign, very safe and secure. And make sure you fill out every field, send it back to me. You can download it, sign it, Adobe, Acrobat or Adobe, fill in, sign, usually. There's other ways too, I know, out there. But fill it out. You can send it back to me. Email a lot of this. So this information, you can email it back to me. It's very safe and secure. I can go ahead and store it in a drive, Google Drive. I can organize it. I can review it first, organize it, or I can organize it a lot of times and then review, take the time to go through this and before I send it over to the lender. And then I can communicate with you what's missing, and perhaps there's something that I saw that may not work, or hey, I don't need to always ask for that or tell you that. It's just send it to me and then I can send it over to the lender. We're good to go. Now over here, we have the personal financial statement form. So over here, I have another tab that I want to use as guidance. So personal financial statement, PFS for short, for 7A, 504 loans and surety bonds. And over here, you just have to fill in some fields like name all the way down the business name of the applicant. And then on the left-hand side, of course, you know that, you probably know this, assets. And then on the right side, what are your liabilities? So make sure you fill those out. Source of income, contingent liabilities. And then just a few bits of more information. If you have that, you can supply that in that doc. You may already have your own, and I would prefer you fill out ours. A lot of the times you'll have to, because it is an SBA type of form, and that's what they're requesting. And when it's government funding, yeah, you better make sure you have what they're requesting in their format. And I'll let you know if you have something like your personal financial statement already created, this needs to be transferred here. And maybe there's a field missing over here that's not in this one, or there's a couple, or there's everything is there. It's just it needs to be here. And so a lot of the times that's what they'll ask for, that we do it this way, that we have it set up like that. The business debt schedule may be a bit different. It may be already sufficient enough with what you have, but the PFS statement, make sure, or the PFS doc, make sure you have that. And then I might need you to submit it on our own debt schedule form for our in-house look, but it's a lot of the times you can use your own. Just depends on lender to lender cases. Now going into, oh, here's one other part. So it also depends on the industry. So if you are in dentistry, for one example, and there are many other ones I could go into, but you would need to supply like your dental license. If it's there, have it. If you have other balances on loans or advances, cash advance balances or documentation of it, and just a few other things along the way we may need to ask for, maybe a business plan at some point, perhaps. Make sure you have some of these things are already in concrete detail of how you're going to use these funds. So if the lender, myself, asks you, how do you plan to use these funds? If we're giving you 5, 7 to 10 years or so, well, there better be a good plan to use this. And that so we don't risk the chance of you going into a default or what ends up happening. A lot of people end up going into collections. A lot of people go into, there's already a lot of past default judgments in place, and we don't want to cause any fraudulent activity like somewhat EIDL loans were, and then PPP loans hugely on that side. So debt service coverage ratio, and then we'll end this video. So DSCR for short, that's an indication of how much cash flow, how much free cash flow you can have to service your current debt obligations, as well as if we gave you any more, how much cash flow would you have for that? And so the normal amount that the SBA 7A loan lenders look for is a 1.25 DSCR. And that just means for every $1 in debt, you're making 2.25. Or if we're looking at it as in net operating income and total annual debt, then we look at your NOI or net operating income should be 125% greater than your total annual debt, or 1.25 times your total annual debt. And I know that can sound a little bit confusing, but I've also created examples on that down below that you can watch in other forms of SBA 7A loans and other forms of financing. So if you're looking for a bridge loan, whether you can qualify for this or not, there are other forms of financing. So make sure you check those out down below if the SBA 7A doesn't apply to you at this moment. And so with that said, it depends on lenders, but 1.25 and above is better. Having less means you have more debt obligations and you can't carry on more debt. You don't have free enough cash flow. So the chances of you defaulting or the chances of you struggling to even make the payments is going to be a lot harder for what we give you over the extended amount of time, because you already have other debt obligations, interest and payments. We're looking at everything like EBITDA and just understanding your profit and loss statements. And I can do a lot of this myself. And I look at your revenue, I look at your expenses, and I tell most business owners this is profitability. I reverse engineer. Like, my mind works with systems and I work at reverse engineering everything. So from the top of your profitability, how did you get there? Is it enough? Is it not enough? Why is it not enough? And we look at it per quarter. And if you have those, great, you should have them. And you should be reflecting on those and seeing for the quarter, and you're revisiting this and going, where was our revenue? Where were our expenses? Where were we making the most profit on? What services, what products? And what you want to do is you want to double down on those. A lot of business owners, and I see this a lot, like especially in the construction contracting field, like there's like one for like electrical, then we do roofing, and then we do, forms of HVAC, and then we're doing flooring. And I go, oh, that's great. And your revenue looks high up there, but your profitability and your expenses are rising, but your revenue maybe isn't. It's staying stagnant. And you're wondering why. And I look at the profit and loss statements and I go, well, here is where you increase. Here's your cost of goods sold. Here is where we can cut back expenses. And then we can work on your marketing budget better, be more efficient at this, or getting these products and services at a lower cost, or making the most use of this, going higher in expenses with these products and services per quarter, per month to month basis, or wherever we're at. But you increase your service, your power in delivering. You get more clientele to focus on roofing instead of working on the HVAC or the whole flooring side, which you're there, just don't have enough. You just want to focus on doubling down and making the most you can out of that product and service. And then over time, then you can expand into other segments. But most business owners, if you want to do everything. You want to be that handyman who does everything, but not one source is growing higher than the other. And that's what you want to do. And I'm a business owner. Like I said, digital marketing agency, affiliate marketing. I focus on the products that deliver the best outcome, the best return on my investment. Here's my conversions. Here's how I can grow and expand that and scale it. And I focused on that before I moved into other segments. Now, I did have those products and services, but what I'm saying is this is the one that I focused on most, and this is what I was doing. Boom, 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 boom. So make sure you have those. And it can go lower than 1.25. We can look at a 1.15 DSCR, even a 1.1 with express loans. More so express loans at a 1.1, 1.15. Yeah, we can look at SBA 7As up to 350,000 and above, I should say, but sometimes less than that. So 1.1 usually gets you up to 350,000, and this is a SBA express loan. And if you're less than a 1.1 or 1-to-1 ratio, if you're breaking even, that's one thing. you're at an equilibrium point. But if you're below that 1.1, it's going to be much harder to get approved for. Now, that's because we look at it on a macroeconomic level on our economy. And we see where we're at, where we will be, where we've been in the past. But if we're increasing and our economy is getting better, then that means we can give you more flexibility, in terms of credit and a few other ways of the borrowing power. And so we can lessen the look at the DSCR, and we can look at the economy and your industry as well. Is it going up? Where's it going to be? And it may not be enough. It may be like, okay, well, this is where our economy is. This is where your market is. And you're less than 1.1. In a different economy, we would have said, okay, you're just below 1.1, or it's too far below it. You already have too much debt you're taking on. And year over year, those 3 years we look at, and we did an average of them, or we look at it even more deeper, and we go, well, it just doesn't make sense. Even the average is high enough, but your most recent year, you've been under the year before that, and then the year before that when you were up. But it's like, where are you going to be at the end of this year? And if it's showing significant increase, and if it's doing better, then we may give you more flexibility and be able to approve you. But anything underneath that, we have to look at the economy. It's per case that we have to look at. Not every lender will shut you down because you're underneath just a 1.1. A lot of them will for those express loans, but we can look at your debt obligations, especially if you have assets, if you have collateral, that may be enough to get you over that. They may ask for that because of where you are cash flow wise. You don't have enough yet. So we might have to look at a piece of property or multiple things, not just real estate, but whatever you can supply if necessary. So it depends, again, lender per lender case. So I think that's where I want to end this video. I believe I've covered everything without going too extreme. Oh yeah, 650 usually and above gets you in. That's what you want to shoot for. A minimum of 650, depends on where you are, revenue, profitability, cash flow wise, but anything underneath the 650, it's hard to get approved for. And you're going to get, even if you'd get little amounts through an express loan, maybe 20 to 50, 20 to 100,000, more or less, even less than 100K in a lot of cases I've seen. But 650 and above, you increase your credit, you increase your borrowing power initially. So 680 above gives you a better chance of getting the maximum amount to get approved for in your what you bring to the table. And so if you have less than that, maybe a minimum of 150,000, but it also depends on where you are revenue wise. That cash flow can help push you over if you have a 650, but you're doing like 10 million a year, you're consistent, and you just, you're 6 figures every year, you're doing this, boom, boom. And we determined that your maximum borrowing power is above 350,000. So we probably get you just above that, maybe 400,000, it's 500,000. But with collateral, maybe 700, 800,000, up to 25 years, more so if possible, but a lot of working capital up to 10 years. Express loans can be sometimes 3, but more so 5 to 7 years, sometimes 10 years, but 5 to 7 is a lot of the times what you'll see. Now, I don't want to spend too much time on that. Look for the qualifications as well as the documents that I'll also go through. But profitability is important. 2 years at least of profitability is what the SBA looks for. Most recent is best. Sometimes just they look at a little bit of 1 year, but more so 2 years in this economy a lot of the time. And so they see that 10% at least for some lenders. Others just go at least 2+ years of profitability is enough. But look for that content down below in the description for the qualifications as well as the documents needed, more or less of what I already covered here, the requirements, the debt service coverage ratio examples, and the alternatives. If you don't qualify for this, there's other ways of getting financing, even 0% interest for 6 to 18 months through business credit card stacking and getting funds on the back end, getting credit lines, getting business credit, vendor credit, adding the two together. It's a recipe for success, and you'll always have funds there. So you're not always scrambling and you need an additional amount. Maybe we increase your limits, you get more borrowing power, you come get a loan. Separate your personal and business credit, or personal and business side of everything, or personal credit and business credit, yeah. And then you'll be better positioned when it comes to utilization, when it comes to having more borrowing power, increasing your limits, and doing things that you would have never been able to imagine. And I tell that to most business owners, especially startups. If you're not generating revenue, pre-revenue, there's ways of doing this, but we have to work on a few things. Maybe there's grants available and a few other scenarios to look at. So that is everything from me. Look down below for all information. Fill out that questionnaire if you haven't yet, and I will talk to you soon. Bye.